Welcome everyone to the Imperium Forex Education webinar. My name is Rob Clayton. In today's session we are going to be talking about one of the most popular momentum oscillators used in trading, the Relative Strength Index, or in simpler terms, the RSI indicator. Just to begin with, I'd like to make a note that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. So, how to use the Relative Strength Index, or simpler terms, the RSI oscillator. The Relative Strength Index, or the RSI, is a momentum oscillator that measures the speed and change of price movements. It was developed by J. Wells Wilder. The RSI oscillates between 0 and 100. Similar to the stochastic oscillator, by that, it identifies overbought and oversold conditions in the market. Getting to know your market with an RSI indicator can let you pinpoint reversals more accurately and thereby let you position yourself accordingly. The RSI is considered overbought when above 70 and oversold when below 30. Alternative signals can also be generated by looking for divergence, failure swings, and centerline crossovers. RSIs can be used just like the stochastic oscillator. We can use it to pick potential tops and bottoms depending on whether the market is oversold or overbought. Divergence. Divergence occurs when the pattern disagrees with the indicator to the price action at the same period. It can have significant implications when trading. Divergence is when the price is moving in an upward direction, but the indicator is moving in a downward direction, or vice versa at the same time. Divergence can be found in momentum indicators or oscillators only. Divergence assists the trader to identify and react appropriately to the potential price change. Therefore, the trader must make a decision about the trade by either taking profit or moving the stop loss. Seeing bullish or bearish divergence increases profitability by alerting the trader to protect their position. So, how to identify divergence? After a long downtrend, prices create lower lows, but at the same time the indicator creates higher low. Acting upon this pattern or signal, we can identify an up or down trend reversal, giving us entry opportunities for long or short positions. In the next example, following the gold pattern, we can first see bullish divergence after a prolonged downtrend which soon leads the price to a sharp reversal to an uptrend. So as you can see here, we've got a price declining with an indicator that's slightly rising. With lower lows in price, we can see a rising indicator lower high. Then the bulls step in. From this divergence, we can see that the market eventually looks back towards that 1,200 mark. And as you can see, the rise is very strong. And with the indicator breaking over that 50 point, confirms the trend. The second pattern displays bearish divergence. As you can see, we make a note that the price has made one high and then a second high when it approaches that 1,260 level. Look at the indicator. The indicator is not making any new highs as prices rise. Therefore, we have bearish divergence. Then the market turns away from that top side and looks back down towards that 1,200 mark. And as you can see here in the indicator, it also breaks through that 50 to confirm the downtrend. In this next example, the Great British Pound versus the US dollar displays bullish divergence on two occasions. As the price is declining towards the 122 mark, you can see here eventually that it did stab towards that 120, making a new low. Look at the indicator, it is rising. So we're getting lower high, and also with prices we're getting the lower lows. And then afterwards the market eventually recognizes the bullish divergence and snaps back to the upside, and we get a rally close up towards that 128 level for the pound. Now look at it back in late December. The market is declining as it approaches in towards January. And you can see here the indicator from the RSI has not made any new low but stayed relatively flat. We have got divergence here. Hence the market snaps to the upside and rallies again towards that 126 handle. Failure swings. The failure swing pattern is a type of reversal pattern that can be used either as a buy or sell signal. In an uptrend, we see a series of successive higher highs and higher lows, but there comes a point when the price fails to make a new high. So with this indicator, we're now heading towards the lower region of that 30 level. You can see the market broke through the 30, made a high, and then as you can see here, the market stopped and looks back towards that 30 level. This is known as a failure swing bottom. So what happens is the indicator declines, attempts to rally, and then what happens is the bottom fails and the market pushes higher very, very strongly as it breaks back above that next high. So let's look at it on the reverse side. So when the market's rallying and we can see the indicator moving through 70, you can see that this is called a failure swing top. And from the decline, the market hits a low, re-challenges the top side near 70, and then as you can see, the market drops back through the lower side of the range and then starts to decline, and then we have a bearish market. So let's have a look at some examples. Here is a graph of the Great British Pound. So there's your first base at 30 where the indicators declined. Then we've got the rise, and then the market drops back, and then as you can see, we eventually get a snap to the upside, and then we break higher, and then the pound rallies. And in this occasion, there's 70. So this is a failure swing top. So the market goes back to retest that level of 70, as you can see there, and then rejects it and then breaks through it, and then the market collapses and goes through the low and continues on towards that 30 lower side of the range. And again, you can see here the market hit the bottom, breaks through from 30, peaks, pulls back, and then rallies and breaks higher. And you can see the market went on to push on for a further rally. So there's two examples of a failure swing bottom and a failure swing top. A center line crossovers. RSI can detect prevailing trend direction by its center line crossover. This center line of RSI is at 50. So when the RSI is above the center line, or the 50, then the trend is up. Inversely, when the RSI is below the center line, or 50, then the trend is down. Therefore, trend reversals occur when the RSI crosses above and below the 50 center line. If the RSI crosses the center line from below, then the trend has reversed to an uptrend from the downtrend. Inversely, when the RSI crosses the center line from above, then the trend has reversed to a downtrend from the uptrend. Next example is a daily graph of gold. It points out where the buy and sell signals are. The first arrow breaks above the 50 center line. This confirms a buy signal. And then you can see the price is actually starting to rise from 1,150. There's your buy signal. The second down arrow rejects the 50 center line. As you can see, the decline challenges that level, but it didn't break it. And you can see from the rejection, the market rallied. The third arrow signal, the decline goes through the center line and breaks. And you can see here the market is falling away. There's a confirmation that a further decline is supportive. the fourth arrow crosses and re-establishes the uptrend. And as you can see here, that from the break, the market rallies back to 1,250. So, what is the formula for the RSI? The RSI uses the closing prices of trading periods to determine who dominates the markets, whether it's either the bull or the bears. Assuming that prices close higher in bull markets and lower in bear markets, therefore computes this as a ratio of the number of the higher closes to the lower closes during a certain period of time. Most commonly used is the period of 14 days. The formula: an RSI equals 100 minus 100 divided by 1 plus RS. Seems simple enough, but the RS part needs to be calculated first. The RS equals 14-day EMA of up-day closing gains and 14-day EMA of down-day closing losses. Now, the EMA stands for exponential moving average and is used to smooth out an average of series of values. This is done by taking the latest 100 days trading, assessing which ones were the up days and which ones were the down days, and then calculate the moving average using 14 days as a parameter. Applying the RS in the first RSI formula will give you a value between 0 and 100. The real test with the relative strength index is to know what boundaries apply for when a market is overbought and oversold. Now, I can't stress that enough. This usually comes to you after having studied a market thoroughly. Common rule levels for the RSI are beneath 20 for oversold and above 80 for overbought, but that is just as a rule and inevitably will vary between each individual market you trade. And I shall explain this a little bit further in the next graph. So here's the Australian dollar over a period of 8 months. Now, there's going to be a few examples in here. So how I'm going to explain it is from the beginning and then point out that from this whole webinar, everything that we've talked about, that's divergence, that's swing failures, and also center crossovers, are all in this chart. So this is a live graph that I took today, and as you can see from the beginning, the RSI pushes up towards 70, was overbought, and the market got to around 77.5 in August and then dropped away. Then the market sold down towards 75 cents and got close to that 30. So you can see that what I was saying in that previous slide, that the markets don't always get close to 30 or to 70 to sometimes imply that we are overbought or oversold. And then when we got down towards the lower side of the range, we found a base around 74.5 in the middle of September, and the market rallied on to 77 cents. Now look here what we have. You can see that we got two highs in the middle, one in the middle of October and one in the middle of November. And as you can see, bearish divergence. And look what the price did next. It plummeted. It fell from 77.5 to 80 and all the way towards 73 cents. Very, very strong signal, that bearish divergence in the Australian dollar. Now, if you were trading that, you would clearly see that was happening. So that's when I say to you in terms of adjusting your position or adjusting to either take profit or move in the stop loss when you're seeing divergence. And this is the one reason why. If you are long, this is a warning signal and that the market is actually fallen very, very heavily. To a point where it got oversold. As you can see here, the market hit that 30 level. And then hence from that, the market staged a recovery just in front of that 73 cent mark around the 21st of November and rallied all the way back up towards 75. And then before that, the market hit the 50 point and then just declined back towards that lower range around the 71, 70 mark, but was oversold clearly. As you can see here, the market for about 6-7 days held around that 71.5 support, and eventually momentum kicked in very strong and took the rally all the way up to an overbought situation. Now, when I mentioned before about when the markets are overbought, sometimes you've got to work out and go back and do some back testing to see how reliable this indicator is. Now, at the moment it's saying it's overbought. Do we get a sell-off? Well, actually we didn't. The market actually went higher. So the market was caught short. And the bulls took the opportunity of squeezing the market out and rallied all the way back up towards 77 cents. But look what we got here now. The first marker on 77 cents in the beginning of February. The third marker around the 14th of February. And then the second high around 21 in price. The indicator was going down the whole of that month, clearly suggesting bearish divergence. And you can see here that the market after that plummeted back towards 75 cents, falling over 200 points. So you can see how powerful divergence is. In both occasions, the first time the market fell from 77.5 nearly to 73 cents, and in this occasion it fell from 77.40 to 75 cents. And then when the market was oversold again, as you can see here, when it got close to 30, it recovers from 75 cents and rallies all the way back up towards 77.5, where it's just finding another top around there and slowly potentially falling back towards that 76 region. So that brings an end to my webinar. Thank you very much for your attention. Imperium Forex will be hosting a weekly workshop every Friday for investors to learn and exchange ideas. We will also be inviting seasoned analysts to share some of their insights on Forex trading every week. These will be commencing from Friday at 4:30 to 6:30 and is at our office in Sunnybank. For more information, contact us at 1-800-388-322 or email info@impfx.com. Thank you very much.